Hello dear friends, I am Dr. Vinod Kumar Advani from the Department of Commerce, the Bhopal School of Social Sciences, Bhopal. Dear friends, in this particular session, we will learn about the money market instruments. This is the part second of our series, money market basics and their features along with the instruments. Before starting this particular instrument, let's see how many types of money market instruments are there. First, we will understand the treasury bills, after that the commercial papers, next will be commercial bills, certificate of deposit, and finally we will learn about call money in the money market instruments segment. At the end of all these instruments, we will learn the major features, main features of all these instruments. Let's start the money market instrument with first major instrument that we have. It is treasury bill. Yes, treasury bill is one of the most important money market instruments frequently used by the Reserve Bank of India to collect the money, to collect the funds from public for central government of India. These bills are safest mode of investment in money market because these bills directly issued by the government of India. Generally, treasury bills issued by the Reserve Bank of India at less price than its face value. Less price means, suppose the face value of one treasury bill is rupees 100, it is not issued at rupees 100, it is issued at discounted price. Suppose it is issued at 96. But these instruments are redeemable at the face value. It means the issue price and the redeemable price, the difference of these two will be the interest on these particular treasury bills. These bills are issued generally for the period of 91 days, 182 days, 364 days, means maximum period of these instruments, these bonds, these bills is 1 year. It is also known as zero coupon bond because they have no interest, but interest is payable in form of the difference between the buying price and the holding price. It is treasury bills and in short form it is known as T-bills. Next we will look at the commercial paper, CP. One more name of CP we have, it is known as also bridge finance. Now, what is commercial paper? It is a particular unsecured promissory note, short term promissory note issued by the high net worth, high rated, well reputed companies to collect the fund for the maximum period of 1 year. These bills are just like, these papers are just like the short term period for short period debentures, but it is not secured, not safe as the treasury bills because these are issued by the companies. Now, CPs, commercial papers, have maturity period of minimum 1 day and maximum 364 days. These commercial papers have the high return, but along with the high risk also. Commercial papers are also traded in the secondary market, means these can be purchased and sell in the stock market also. This is commercial papers. Next, we have commercial bills. Commercial bills, another name is bills of exchange. It is another mode of collection of short term funds in money market. It is a particular type of promissory note. It is drawn by the creditor and accepted by the bank of the debtor. This bills of exchange or commercial bill is generally used for the finance of 1 month, from 1 month to 6 months. So, maximum period of these bills is generally 1 month. These instruments have the feature of the liquidity and freely transferable from one person to another person. These bills can be transferred from one person to another through the endorsement, and these bills can be discounted from the banker in case of need of funds, requirement of funds. After the maturity period, this bill is paid by the acceptor or you can say the debtor. Next, we have the certificate of deposit, CD. Now, first of all, certificate of deposit is different from the fixed deposit that is related with the bank and the public. Now, Certificate of deposit is a particular deposit receipt for money which is deposited with the financial organization or generally a bank. Certificate of deposit is different from the fixed deposit. We have two major differences. First, the difference is CD is issued for a large sum of money. Yes, it is 1 crore, 5 crore, 10 crore, 50 crore, but fixed deposit can be for rupees 5,000, 10,000, 50,000, 1 lakh, but CD cannot be for 5,000, 10,000. CD always carry a larger amount, a huge amount. Next, fixed deposit receipt or fixed deposit in bank is not transferable, but certificate of deposit is freely negotiable or freely transferable. It means suppose I have a certificate of deposit, I can transfer this particular deposit receipt to another person, to another company, to another bank. So, it is also one of major money market instruments. CDs are also issued at a discount price and the period is minimum 7 days and maximum it is for 1 year. After that particular period, the certificate of deposit mature and the payment will be given to the holder. Dear friends, next and the last money market instrument we have call money. This call money instrument or collection of funds call money generally used by the scheduled commercial banks to arrange their short term requirement of fund or day to day requirement of cash. This particular call money is used for minimum 1 day and maximum for 14 days. If call money is made for 1 day, it is known as call money, and if call money is made for maximum 14 days, it is known as money at short notice. Generally, this particular call money instrument used by the banks to arrange the liquidity problem or to solve the liquidity problem. In this particular instrument, bank borrow and lend funds in the market, but financial institutions and mutual funds are not allowed to raise money through call money market. They can participate as the lender of the funds, means banks can collect funds from financial institution and mutual funds, but financial institution and mutual fund cannot collect money as call money in this particular market. Yes, because it is very short term market, the interest rates in the market are market driven and highly sensitive according to the demand of the supply of the funds on that particular day. So, interest rates on call money are fluctuating according to the position of demand and supply of the funds on that particular day, on that particular date. Dear friends, now we covered main money market instruments and now we can discuss about the features of money market instruments. How are the common features? How are the common features of money market instrument? We can explain, or many money market instruments we have. What are the common features in all these money market instruments? First feature, I think, is liquidity. Yes, all money market instruments are freely transferable. So, we can arrange the money by buying, selling of all these instruments. All these money market instruments have a special feature of liquidity, mean easily can be converted into cash, Next, safety. Almost all the money market instruments issued by the high rated companies, good companies, companies with good track record, or directly by the central or state government. So, all these instruments are safe as per the investment criteria or as per the requirement of the investor, means there is no chance, almost no chance of not recovery of the funds or the not collection of the funds from the lenders to borrowers. So, safety is also main feature of all these money market instruments. So, investor can invest their money without any problem. Next, we have discounted rate, discounted price. Some money market instruments are issued at a price that is less than their face value. Suppose that is treasury bill. Treasury bill of 100 issued to investors at rupees 96, at rupees 97, at rupees 98. So, the difference between this price and face value will be the interest income of the investor. It is known as issue of the instrument at discounted price. This discount later automatically converted as the interest income of the investor. So, we have main three features of these instruments: liquidity, safety and discounted price. So, dear friends, in this particular session, we covered two topics. We covered major money market instruments: treasury bill, commercial papers, commercial bill, certificate of deposit, call money market, and finally, we covered main features of this particular money market instrument segment. I hope now the concepts of money market instruments are clear. You can understand, you can learn about money market instruments easily. Thank you.